Howdy, folks. Jeff Camarda, Thursday, September 3rd, on the cusp of the COVID year, Labor Day weekend. Good cheer and health to all of you. It'll come as no surprise to most of you that it's been a pretty traumatic day in the market. Significant drops across the board. NASDAQ pulling back 5%, which is a huge deal. This is the technology heavy. The sector, in our view, way overextended. Apple, Microsoft, Google, Facebook, all trading kind of crazy valuations. Not that they're not great companies, but gee whiz, and just things just don't go straight up untethered from economic reality. But in any event, I thought this would be a good time to kind of refocus on what our strategy is going forward. These are unprecedented times, and we're more concerned with protecting client value and retirement ability, wherewithal for the long term, for the rest of your lives, than any particular valuations at one point in time in this crazy year, which we think are really stretched. Which is why we've kept so much dry powder, because we think there's a significant the risk of a market plunge. Just because the stock market value is completely, in our view, divorced from the underlying economic reality that, the prices just aren't justified. It's kind of a speculative fervor. It's a bubble, and a lot of you may not remember what a bubble is. And it's really a period where prices people just pay higher, thinking that it's going to go up forever, and it never does, until the music stops and somebody's stuck without a chair to sit down on. And you may be reminded of the South Sea bubble from the history back in grade school, or the tulip, frenzy in Holland. Remember, where people would just go crazy for the price of a tulip and just go up higher and higher until they realize, gee whiz, a flower bulb ain't worth $100,000, and the market fell apart. That's what a bubble is, and bubbles occur in all kinds of investment and asset levels, and I think this is a stock market bubble right now. So again, that's our underlying objective, is to help pilot you through the stormiest financial seas that we think you'll ever see in a lifetime, that we're in now, and get you through to the other side with value intact, so you can realize your financial objectives, not, to show a real high number on the September 30 statement. It really is what, it really is what you keep and get to spend that matters. And that's our objective. So I'd like to read you a couple of editorials, one from today's Wall Street Journal and another one recently from CNBC, compliments of my younger brother, Michael, a Yale man, poor devil. To channel Jim Backus and Gilligan's Island. And this is from the Journal. And so we interrupt this regularly scheduled presidential campaign for a word from your bill collector. The spoil sports at the Congressional Budget Office reported Wednesday, that was just yesterday, that the U.S. government will soon have a debt burden equal to America's entire gross domestic product, a huge number. Congratulations, they say, on this Italian-style fiscal milestone. One way or the other, we'll be paying this off for the rest of our lives. The Congressional Budget Office reports that the lockdown, recession, and explosion of spending this year, and ain't over yet, will increase the budget deficit for fiscal 2020, which ends soon, to $3.3 trillion at 16% of GDP. This will be the largest annual deficit since 1945, when there was merely a world war. The pandemic has become the fiscal equivalent of a war, thanks to the economic lockdowns and the competition by both parties to ease voter anxieties with cash in an election year. The political class seems to agree this is a price worth paying, since neither party wants to talk about it in their election campaign. The fight over the next phase of coronavirus relief has been whether to spend another $3 trillion, the House Democrats, or merely $1 trillion, the White House. Either of those numbers would send the deficit higher than the 8.6% of GDP that CBO projects for fiscal 2021. We won't focus, I'm not going to mention this, but doesn't matter. where they say not your name, but we thought some of our younger readers or viewers still anticipating their prime earning years might appreciate a look at the bar tab. CBO says federal debt held by the public will hit 98% of GDP this year. Debt held by the public is important because of the amount America has to pay back with interest. That's the Congressional Budget Office, CBO's. Public debt estimates don't include entitlements like Social Security and Medicare, which are political promises rather than binding contracts, which means the actual, the debt is much, much bigger. They also exclude the liabilities of Fannie Mae and Freddie Mac, the housing giants guaranteed by taxpayers, and they don't include the $1.5 trillion or so in student loan debt that may wind up in taxpayers' lap if Joe Biden wins. It's important to appreciate how fast this increases happen. The pace of spending picked up across the George W. Bush years, but debt stayed pretty much under control. Then came the 08-09 recession, which Barack Obama and Nancy Pelosi addressed with a spending blowout and the slowest economic recovery since the 30s. Public debt hit 76.4% of GDP by the time Mr. Obama left office, and it kept rising in President Trump's first 3 years to 79.2. And again, this is apolitical. I'm just reading the journal. The journal, if anything, is certainly not particularly politically aligned. Then the pandemic hits. On present trend, that is, without another $1 trillion bonanza, just on the present trend, and I think it's going to get worse. Debt will exceed 100% of GDP in 21 and reach 107% in 2023. That would be the highest in U.S. history, exceeding the previous peak in 1946 at the end of the war to save Western civilization. To put it another way, the U.S. government will soon owe more than the American economy produces in a year, which is a lot of money, a lot. An optimist might say we can again gradually slow spending growth as we did after World War II, but that was before the rise of the entitlement state and its growing claims on tax revenue to pay retirees. Good luck reforming those programs now that the baby boomers are retiring by the voting millions. Defense spending is already down to a low 3.3% of GDP amidst significantly rising global threats. So don't look to get any money from the defense budget, they say. That leaves monetary theory, that miracle that basically says you can print as much money as you want and it doesn't matter. Well, I think it does, which includes, the journal says, keeping interest rates at zero or negative for as long as possible. This would make financing the debt easier, though it also makes annual deficits politically easier to run. If modern monetary theory leads to inflation, as I think it certainly will, that would shrink the debt in real terms, albeit by also hurting creditors and savers. This is probably the likeliest outcome. That's basically the dollar plunges, right? You pay it back with less and less valuable dollars. The dollar's already dropping like a rock on world markets, and I think that it really may just be getting its plunge. Which is a bad thing, right? So that means that if things become much, much more expensive, you got to maybe have a $15 McDonald's hamburger to put things in context. Back to the journal. Sorry to spoil the spending fund, but there's no such thing as free borrowing. Even the U.S., with all its economic power, can't keep piling up debt forever. No one wants to think about it now, but eventually our old friend Adam Smith, Wealth of Nations economic genius, 18th century genius, will come calling to collect his inevitable and pitiless fee. In other words, it's probably going to hit the fan. We're going to be in the woods a long time. This, if you're still watching, it's awfully long-winded here from CNBC. Compliments of dear brother Michael. Asset prices could be on the cusp of a sharp collapse known as the Minsky moment, and may retest lows last seen in March, according to Ron Williams, market strategist and founder, RW Advisory. Markets have experienced a broad bullish period in recent months. The markets are running right up, right? As investors bet on further stimulus from governments and central banks and the prospect of a coronavirus vaccine. Despite lingering global economic risks from the COVID pandemic and geopolitical tensions, Wednesday saw, that was just yesterday before Thursday's plunge. Well, the S&P and NASDAQ notched record highs, while the Dow closed above 29,000 points for the first time since February. A Minsky moment named after economist Hyman Minsky refers to a sudden market collapse following an unsustainable bull run, which in this case could be fueled by the easy credit environment created as a result of unprecedented fiscal and monetary stimulus measures. Those printing presses in Washington again. Particularly if we look outside of the U.S. and the rest of the world, the U.K. here in his home base is actually quite negative, and we've had a new range break out to the downside here. So European stocks, British stocks, actually down 20% still for the year. In stark contrast to U.S. markets surpassing their pre-crisis peaks. For example, the S&P 500 is up 11% year to date as of yesterday. William also pointed out liquidity and volatility as historical indicators of what could be around the corner. He says ETF exchange-traded funds flows on the S&P 500 is at a new record low. And if we take a look at the VIX, which is volatility, the fear gauge, it was also been an interesting atypical spike up. That means fear is increasing as markets go up, suggesting potential hedging for downside risk. The Minsky moment cited by William could see assets fall by 20 to 30% or more. Those are stock prices, causing the current V-shaped recovery to lead to a rolling W retest of the March crash low. And that's enough of that. So again, there are significant reason in our view for caution, and our strategy basically is we don't know, right? The market could come tumbling down as I expect, and we can shovel in the remaining cash and dry powder and pick up some stuff really, really cheap, and we'll need it really, really cheap in order to weather, the heavy seas ahead. Or it can continue to go up. This could be a blip. I don't think that's going to happen. But in order to hedge our bets, we still are about 50, 60% invested there. So anyway, that's kind of an encapsulated the description of what our strategy is going forward. I remain accessible to all of you if you have particular questions or concerns about our strategy. It's got to be rough going, guys. And our overriding mandate is to preserve the value of our beloved clients, to get them through this crisis, to be able to enable them to realize as many of their financial goals as is possible, not to do some the smoke and mirrors, the ethereal or fleeting, investment performance. Anyway, that's enough for now. I wish you all absent, a disaster or some really crazy news. Tomorrow, Friday, we probably won't hear from me again until after Labor Day. One other afterthought, though, there's a lot of noise about, vaccines coming out this fall before November. Please forgive me. And again, I try to be apolitical, but I think that's more election related than anything else. These are experimental medicines. There haven't been really trials or, academic studies. They may be safe, they may not be safe, they may be effective, they may not be, but certainly not panacea. Certainly I wouldn't assume that, the vaccines are going to be coming out and everything will be fine. I hope it is, I really do, but I will not be the first one in line to drink any of the COVID vaccine Kool-Aid this fall, I'll tell you that. Anyway, best to all of you. Until next week, I hope, goodbye.